Stocks under pressure today from higher treasury yields. Joining me now, we've got Bryant VanCronkhite, who is the Allspring Global Investments Senior Portfolio Manager. Great to have you here with us, Bryant. You say the Magnificent Seven's weight in the S&P 500 creates risks for investors. So explain those risks and then where you see opportunity ahead.
Yeah, it's a risk of being complacent. The returns of the S&P 500 and the Mag 7 specifically have been tremendous. And we've all been happy looking at our statements over the last 24 months saying how much appreciation we've seen in those 7 stocks. But that's a risk because the market is broadening out right now. Earnings growth rates for these small cap and mid cap companies are accelerating above the rate of the Mag 7 growth rates in 2025, which should put pressure on the spread between the multiples. We don't want to pay as much of a multiple for companies that are growing slower, which is the Mag 7, compared to the broader market, which is the Russell 2000 and the Russell mid-cap stocks. And so complacency with your large cap and your Mag 7 could be a risk. That doesn't mean sell it. Doesn't mean leave. Just be careful about staying too long, rotate down.
Okay, that's exactly what I was about to ask. As we're thinking about the earnings growth rates as well, earnings growth rates between the Mag 7 and the rest of the market, what do you believe that spells out for larger relative performance here?
I think the opportunity here is to understand what's happening with the broader economy. Investors want to be positive on the America First policy that's coming into place. They want to believe that the lower regulatory backdrop and burden will be positive for companies. And typically when that's happening, you want to move your equity down cap. You want to move into small caps, which benefit more broadly from a stronger economy. And you want to move to where valuations are cheaper, which are the value stocks today. But we're not seeing that. And the reason we're not seeing that is because we're fighting against a now an unfriendly Fed. Look at the 2-year yields. As it has moved higher in Q4, that's putting pressure, downward pressure, on the market's belief that equities and down cap will rally. So right now it's the battle between policy and Fed, fiscal policy and Fed, and we have to figure out which one's going to win. But if and when the market believes fully that the Fed and the fiscal policy work together, the amount of outperformance of small caps could be meaningful given the discounted valuations versus large cap.
You know, even as you were mentioning that investors want to believe that there is more promise in kind of the America First agenda that is set to really be prioritized among the incoming Trump administration and Trump 2.0 here, there are some major companies that have larger outsized risks. Some of the largest companies in an Apple that get talked about, a Tesla even in their own growth strategy have largely leaned on Gigafactory Shanghai to build out some of what the investors expect to come forward to in the broadening of their own revenue diversification as well. I wonder how you're evaluating that in tandem with some of those very names being Mag 7 names.
It's a great point. It's one more risk for the large cap companies. They haven't had to face it in a long time. The America First focus is going to, by de facto, just put pressure on some of the global supply chains and the global customer bases that these larger companies have. Not all companies have this condition, but as you move down cap, you're more likely to see companies that have a higher percentage of revenue coming from the U.S. client base. And so it's a positive there for small caps as well. So global companies have to be very careful about the likelihood of their supply chains being disrupted and the opportunity for their customers to have to face different tariff structures or just higher prices in general.
Where are some of the sector opportunities that you believe are set to prevail or outperform in 2025?
Well, I'm a little cautious on banks. To start where I'm not excited, because the market's very excited about banks right now. I'm very concerned about the market's optimism around small cap and regional banks in particular. The large cap banks have material competitive advantages that are not going to go away. In fact, they're going to get stronger as CCAR potentially is removed and the regulatory backdrop changes. So I think the optimism around banks, down cap, is a bit nerve-wracking for me right now. Conversely, where I like to go right now is I want to push that capital into materials, where we've seen some of the packaging names, some of the chemical names go under extreme pressure over the last 12 to 24 months. And I'm also seeing opportunity in healthcare. Healthcare has gone through a tremendously negative rhetoric as we've gone through the election cycle, and valuations there look really attractive to me. And these businesses have stable cash flows that are no near as volatile as what the market's reflecting through stock prices today.
And what about individual names? Who are you tracking? What's at the top of your list in terms of the companies that you're piling into to start the year?
Well, 2 names I like, sticking with the sectors we just talked about. Graphic Packaging in the material space is a packaging company going through a multi-year transition. They're on the very tail end of that right now. That transition is going to see an improvement in the stability of cash flow because they sold off their more commodity-like assets. You're going to see a growth in the margin structure as they focus on value-based pricing. And you're going to see expansion of their capacity as they complete their big CapEx program in Waco, Texas. And so Graphic Packaging to me is a company going through a transition the market hasn't fully appreciated yet. On the healthcare side, Charles River Labs is a business that we like and believe that the clinical research organization companies in general are underpriced today. CROs are companies that help pharmaceuticals and biotechs get through the clinical testing phase. And we've seen a pullback on money spent on R&D and testing as pharma companies have merged and as interest rates have moved higher, putting pressure on available capital. That is not sustainable in the long term. These companies need to invest to develop drugs, and that will continue to happen again. Charles River has been investing through this trough in their cycle, which we think positions them well to have a much bigger market share and ultimately bigger cash flow streams as we get to the other side of this downturn.
Bryant VanCronkhite, thanks so much for taking the time here with us today. Appreciate it.
Pleasure.